My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to present an overview of bonds payable, corporate bonds payable, which is one of the many ways that corporations have to finance their operations. And bonds payable is an example of a long-term liability. So the first thing to discuss is exactly what are bonds and what are some of the common characteristics of bonds. Well, bonds are obligations that the issuing corporation agrees to repay a stated amount, which is sometimes referred to as the principal amount or the par value or the face amount or the maturity value. Those terms all mean the same thing in the context of bonds payable. And so a bond is simply a borrowing instrument. Company is going to borrow dollar amounts from investors, and they agree to repay that principal amount at some specified maturity date. In return for the use of that money for 5, 10, maybe even sometimes 15 years, the company will also agree to pay interest to the bondholders between the issue date and maturity. Notice here that means that most bonds are essentially interest payment only while the bond is outstanding. So we borrow some money today, and for a period of time we will be making interest payments, and then at the maturity date we will repay in a single lump sum the maturity value or the original amount that we borrowed. Now, there are some common characteristics of bonds. Most bonds, a vast majority of bonds, are what are known as debenture bonds. So debenture bonds are simply bonds that are secured by the full faith and credit of the issuing company. In other words, they're not borrowing through a financial institution of any sort. They are issuing bonds directly to investors, either individual investors or institutional investors. But there is no guarantee of these debenture bonds that the investors will see either their interest payments or their principal payments. There is some risk here. Now, a company, for example, like IBM is significantly less risk than, say, a company in the tech industry or in biomedical engineering or something like that. IBM is a well-known, well-established company, and they would have no difficulties issuing bonds based on the promise that they will repay interest and repay the principal amount. Other types of characteristics or other types of bonds, there can be mortgage bonds, which are secured with a lien on specific assets. That offers the investors significantly more security, because if the issuing company defaults on the bonds, then the bondholders have a claim to a specific set of assets. That reduces the risk associated with investing in bonds. There are also what are known as registered bonds, and in fact most bonds are what are now known as registered bonds. There are coupon bonds and registered bonds. Most bonds issued in today's market are registered bonds, which means that when you buy or when an investor buys a bond, they will register that bond, and then the interest is sent directly to that registered owner. And if the bond is subsequently sold to another investor, that investor will re-register the bond so that they will ensure that they can get the interest payments. There are also sometimes what are known as callable bonds, which allows a company to buy back bonds before their maturity date. So a company needs to borrow money, they think they will need to borrow it for 10 years, and then 3, 4, 5, whatever, 7 years later, they decide that they can actually pay back the bonds early. And so if they have issued callable bonds, then they can say to investors, we are going to repay this bond early. There are certain advantages and disadvantages to callable bonds for both the investor as well as the issuing company. Can also be what are known as convertible bonds. And convertible bonds are bonds that can be converted into shares of stock at the option of the investor. And so convertible bonds offers a degree of flexibility for the investor. So they can lend the company money with some guaranteed amount of interest payments, but if they decide they want to take advantage of the equity securities, common stock or preferred stock or something like that, then if they are holding convertible bonds, they can, at their option, turn those bonds in and convert them into shares of stock. And the bond issue would state what the exchange rate is. So for each bond certificate, you can exchange that for 100 shares of common stock or 10 shares of preferred stock or whatever it might be. By the way, bonds are issued typically in millions of dollars, but the individual bond certificates are most commonly in $1,000 denominations. So that means if a company is going to issue $1 billion worth of bonds, then they're going to have to print up a whole boatload of bond certificates in $1,000 denominations. And each one of those certificates represents a promise to pay the maturity value at the maturity date, along with interest payments in the intervening period of time. Typically, the standard interest payment period is 6 months. So bonds will typically pay interest every 6 months or make 2 interest payments each year. Okay, so let's take a look at an example of a bond issue. So I'm going to swap over here to my web page. So in 2012, July of 2012, IBM, for example, had a new debt issue, specifically a bond. And we can see here that IBM issued $1 billion worth of 10-year debt, which is coming in the form of bonds, with a coupon rate of 1.875%. Now that's a very low interest rate. One of the advantages that IBM has in the marketplace is that they are a very well-known, very stable, very secure corporate entity, and so they are able to issue or borrow money at a very low rate. So in 2012, they were issuing $1 billion of interest, or I'm sorry, $1 billion of bonds. The bonds will be outstanding for 10 years, and they are paying just under 2% interest rate. Now, let's see how that shows up on IBM's financial statements. So now I can swap over to their annual report. This is IBM's 2012 annual report, and the first thing that we're going to take a look at is the income or the balance sheet. So here's our balance sheet as of December 31st, 2012. I'm going to scroll down here, and we can see that among the liabilities, some of the current liabilities as well as some of the other things, we have some long-term debt, and there's a total of $24 billion worth of long-term debt on IBM's balance sheet. And we also can see they're kind enough to organize their financial statements, and they give us some information about what footnotes relate to providing additional detail about their long-term debt. So notes D and J will give us some additional detail about what makes up this $24 billion. So I'm going to go ahead and skip to footnote J, and we can see here, here's the total long-term debt for 2012, and we see that they have $24 billion. That's what shows up on the balance sheet as a part of their assets equals liabilities plus shareholders' equity. Also, interestingly, in this line right here, we can see this line right here, we can see that $1 billion issue. Here's the $1 billion of principal amount, Here's the interest rate. Remember, the interest rate from the article was 1.875, and so they've rounded it here to 1.88%. And the maturity value is 2022. The bonds were issued in 2012, and they will mature in 2022. So that's how a bond issue is going to appear on the financial statements for a company. So we've seen what happens on the balance sheet itself, and then we can go into the footnotes. And in this particular case, we're actually able to find that particular bond issue. Okay, so I'm going to head back to my presentation here. So we've got some common characteristics. We've seen an example of a bond issue and how it would appear on the financial statements. A couple of things with respect to issuing bonds payable. This video is not going to get into the details of how to account for bonds payable. That will take place in another video presentation. But when a company is issuing bonds, there is generally a lapse of time between the issuing company deciding to issue the bonds and when the bonds are actually sold in the market. So a company may decide to issue bonds, say, make the decision to issue bonds, say, in March, but not actually issue the bonds until April or May. What that means is that the expectations of investors may change due to changes in market conditions. So the stated rate of interest on the bond may end up being different from what the investors expect or want as a market rate or market yield. And so we need to understand the impact of the relationship between the stated rate, what's actually printed on the coupon of the bond, and the market rate, what the investors expect as a rate of return. So here's the key. If the stated rate, the contractual rate on the bond certificate, is exactly equal to what the investors are expecting as a rate of return, then the bonds will simply be issued at face value. So for example, in the case of IBM was issuing bonds at 1.875 because they are a very secure, very well-known company. Investors were willing to accept that 1.875% rate of return, very low interest rate, but nevertheless, investors were willing to accept that as an interest rate or as a rate of return, and so their bonds sold at face value. If the stated rate is more than the market rate, which doesn't happen very often, then the bonds will be issued at a premium. If the company is willing to, say, pay 3% interest, but for whatever reason the market rate or the market yield expectation is only 2%, then the investors will adjust what they're willing to lend the company initially, and the bonds will sell at a premium. The most common sequence of events is when the stated rate is less than the market rate. So the company is willing to pay 3%, say, but the investors are expecting a 4 or 5% rate of return. When that occurs, bonds will be issued at a discount. If the company is willing to only pay 3%, but investors want a, say, 5% rate of return, then the investors will lend the company less money to begin with. The bond certificates are already printed up. We know exactly what the face value is. We know what the stated value is. The company is not going to go back and reprint thousands, tens of thousands of bond certificates just to match what the market expectations are. So the market makes an adjustment for the amount that they will be willing to lend the investor. And the stated rate being less than the market rate is by far the most common situation. Most bonds are going to sell at some sort of discount, partly because the issuing companies want to save their cash flow. So they will, if anything, underestimate what the amount of interest that they're willing to pay. And so most times the stated rate will end up being less than the market rate, and therefore the bonds will sell at a discount. When that happens, when there is a difference between the dollar amount that is being lent, in other words, either the bonds are being sold at a premium or discount, and the face value. So if there's a difference between what the bonds are being issued for and the face value, we have to amortize that premium or discount. That difference becomes part of the interest expense over the life of the bond. We have two choices in how to amortize that interest. It's either the effective interest method or the straight line method. Most firms will use the effective interest method. That is the preferred method by the FASB as well as international accounting standards. And quite frankly, with the computing technology that we have now, software, it's much easier to put those schedules together, those amortization schedules put together. So there are three things that we need to be concerned with, and we'll get to an illustration a little bit later on. Three things that we need to be concerned with in terms of dealing with this amortization of the premium or discount. First of all, the amount of cash paid for interest is always going to be equal to the stated rate times the face value of the bond times the portion of a year, which would typically be half a year or 6/12 of a year. So the cash going out for interest payments is always going to be whatever is printed on the bond certificate multiplied by the face value of the bond multiplied by the portion of a year for which the interest is being paid. Now that's the cash out. That would represent our credit to cash. Interest expense is the key calculation. Interest expense is going to be the market rate multiplied by the unamortized balance of the bond payable times the portion of year. So the market rate, when the bonds are issued, there is some sort of market rate or market yield expectation. We will know what that is. We will also have the unamortized balance of the bond. That means whatever the net of the face value plus the premium or minus the discount. That's going to be the balance in the bond payable account, multiplied by, again, the 6/12 or half a year typically. That will be our interest expense. The difference between interest expense and cash paid is going to represent the amortization of the premium or discount. So interest expense could be more than the amount of cash paid or could be less than the amount of cash paid, depending on whether the stated rate was less or more than the market yield to begin with. But the difference between the interest expense and the cash paid is going to be the amount of the premium or discount that needs to be recognized, and that will typically take place every 6 months or certainly every interest payment period. So those are three critical issues that we need to make sure that we pay attention to, and in particular the interest expense calculation.